Hello and welcome to Startup Street. I'm Arundhati Ramanan, and with me from the Bangalore studio is Ritu Singh. These are the top headlines from the startup world. Government introduces a bill proposing to ban the $25 billion online real money gaming industry. Centre claims broad political support, argues for larger social good by curbing addiction and debt spirals. But Karnataka's IT minister calls a blanket ban knee-jerk and bad policy making.
Data analytics software firm Databricks has signed a term sheet for its Series K round, which it expects to close soon with backing from existing investors. The funding values the company at over $100 billion. It expects to use the new capital to accelerate its AI strategy, expanding Agent Bricks, investing in its new database offering Lakebase, and fueling global growth.
Weaver Services, a tech-led housing finance platform, is raising 1,481 crore rupees in funding led by Lightspeed and Premji Invest. The funds will support asset acquisitions, tech development and expansion.
IIM Calcutta Innovation Park has launched a 50 crore rupee fund for clean tech and sustainability startups to be deployed over the next 12 to 18 months. The fund will support early-stage ventures working in clean energy, climate resilience, sustainable agriculture, and waste-to-value solutions.
As part of a project known internally as Kitty Hawk, Amazon plans to release a higher-end tablet as soon as next year, offering the Android operating system software for the first time. If Kitty Hawk is successful, Fire tablets could be more desirable for consumers who crave compatibility with other Android devices, the report added.
And those are the headlines that we're tracking for you today on Startup Street. But the top story that we're tracking this evening, the union government has tabled a bill which proposes a sweeping ban on online money games. IT Minister Ashwini Vaishnav introduced this bill in the Parliament today. The bill highlights the proliferation of online money games have had a harmful effect on families, society, and the economy, and calls for prohibition, regardless of whether the games are based on skill, chance, or a mix of both. The IT Secretary, while defending the bill, said political leadership was clear about the need to act against online money games. Karnataka's IT Minister has also called this blanket ban a knee-jerk reaction and bad policy making. Let's go across to Ashmit Kumar, who decodes the bill for us.
Well, the government clearly has its mind made, saying that there's no room available as far as online real money gaming is concerned. The bill's been tabled in the Parliament. What highly placed sources within the government tell us is that there's unanimous support across party lines, going on to say that this is an issue that's affecting the society, saying that 45 crore people are affected in the form of losses. The losses estimates say, as per the government, these losses stack up to over 20,000 crore rupees on an annual basis, and that's the reason why there was a need felt for the government to intervene. As a part of this intervention, this bill very clearly spells out complete prohibition, complete curtains on any form of online real money gaming. In fact, real money gaming has been defined in the bill as not making any distinction between what is skill, what is chance. All forms of real money gaming are prohibited. Endorsing, advertising such platforms is also prohibited. Banks, financial institutions are prohibited from allowing any transfer of funds from the user to such platforms. What the government says is that through this bill, they want to recognize that the users are in fact victims, and therefore there is no legal penalty for them, but there are definitely teeth. Those found violating these rules, these provisions of the bill, could face jail terms as high as 3 years. There could be penalties as high as 1 crore rupees, and not just that, even for companies that are found violating the provisions of this bill, they could potentially face legal action. The bill clearly says that people in decision-making positions in those organizations, in those companies, could also be liable to face legal consequences.
Entire middle-class families, they are losing their entire life savings in online money games. Extreme cases are there where children commit suicides, where people commit suicide because they are not able to face the losses which happen because of online money games. It was very important to save the society from the harmful impacts, and I do understand the overall picture, and within that picture our endeavor will be to make sure that the game makers, the people who write games, the creators of games, they keep getting the promotion within the two segments which are very important for the society.
And moving on Investor Eye today, Artha India Ventures has closed its Artha Select Fund at 432 crore rupees. overshooting its target by 131% and taking the firm's total assets under management past 1,200 crore rupees. Marketed as a winners-only vehicle, ASF will double down on the top 15% of Artha's 135-plus portfolio companies, writing Series B and C checks of around 20 crore rupees each. With 80% of capital anchored by Indian family offices and the rest from global investors, ASF aims to plug India's missing middle funding gap, ensuring proven startups have the capital and backing to scale globally. Joining me now to discuss the firm's plans is Anirudh Damani, MD of Artha Group. Anirudh, thank you so much for taking time out and being here with us on Startup Street. You know, as I just said, you closed Artha Select Fund at 432 crore rupees, oversubscribed by 131%. What does this strong sort of response from investors signal about confidence, not only in your model, but about also about like India's, you know, startup ecosystem?
First of all, thank you, Arundhati. Thank you, Ritu, for the wishes. I know it's been a very interesting journey, quite honestly. What we've noticed is that early stage funds usually take that, about 3 years to graduate a company from seed to Series A. And family offices that are for the first time entering the AIF market or to invest in startups, they're preferring to see companies that have already matured or gone through that valley of death, which is what really led to the success of this fund. Is that a lot of families that wanted to say, hey, we don't want to really invest very, very early, but we want to invest in companies that have passed the muster, they've gone through the valley of death, and we want to invest in companies that are breaking out. They've just got their Series A, they're doing their Series B, Series C. That's where our fund comes in, and that's why the success of the fund. I think there is a lot of enthusiasm within family offices to participate in the Indian startup ecosystem. They may not want to take all the risk of seed, so they've decided to back something that is a winners only fund.
Right, absolutely. You know, it is focused on the top 15% of your portfolio, right? So how do you sort of identify these winners, and what sectors or themes are looking most exciting for you right now?
So we have a proprietary framework we call Scout, which is, we look for companies that are solving real human problems. There are category winning companies with optimized unit economics, with companies that are which have an unmatched right to win, and companies that are tech enabled but not tech first. And then all of these frameworks, along with the exponential scale, that's the way we look at companies. And so that framework usually defines within the first 3 years whether the company is actually going to be something that will give us alpha returns. And the way where this fund comes in is after 3 years of watching those companies, within the venture fund, where we've done the seed round, the pre-series A and the series A, we then look at those companies breaking out, and that's where Select comes in. So it's a journey that we have already seen with the founder, with the company, for at least anywhere between 24 to 36 months before the winners fund comes in. That's where this money makes a lot more sense for the company. It's no longer trying to get the company out of the valley of death. We're actually looking at expand. The only focus for this capital is growth. Now, to your second question, what are we looking at? First of all, we don't believe in sectors. We're a thematic investor. Thematically, right now, we are very excited about the Indian deep tech ecosystem. Obviously, our first investment from Select was in Agnicool, and we continue to back that company. We've done investments in space tech. We're looking at investments in semiconductors. I think almost 30% to 40% of our current strategy is to invest in those kind of deep tech sectors. And then we're looking at the affluent Indian consumer and fintech infrastructure, as well as applied AI as the remaining 3 themes we're investing in.
So a few themes there that you're betting big on, but if you can see your exit strategy, right? You've had about 33 successful exits already, and you've sort of built a reputation for disciplined investing. What kind of learnings from those exits are shaping ASF's strategy today?
So I think it's important to have very strong alignment, right, with a founder, right? And not every company, Arundhati, is supposed to scale. Not every company is supposed to be venture fundable. In fact, out of 34 exits, 9 of our exits were buybacks, where the founder bought us back because the company became profitable enough for them, but they realized that scale could actually be the problem here, right? Not every business is supposed to scale. And I think we discover that in the first 3 years because of this Scout framework, that if the company can achieve Scout, but not the exponential scale, it's still a great business. Just because it cannot take venture funding doesn't change the quality of a business. The only thing that is changing is if you can't have exponential scale, then venture capital is a very expensive form of capital to rely on. And what we discover in that first 3 years is whether we're going to hold on to that company throughout that 10-year journey till the exit, series D, E, F, or IPO, as has become popular right now, or is it the time to exit before Series A or at Series A, while the company is still, able to do well, but does not need to scale because maybe it cannot handle scale, or maybe the market is not big enough for it to scale, and which is why ASF then becomes like this very clear sieve, if you will, a very clear indicator from our side that we believe the company has the ability to scale, very fast and into a very big market.
Absolutely. And, if you could quickly tell us, your AUM has now crossed 1,200 crore rupees, right? And you have a target of 10,000 crore rupees by 2032. What does the next phase of growth look like for Artha, both in India and globally?
So we're looking at setting up our entities in Gift City. So we're looking at Africa as being a very big market. I think India is about 15 years ahead of where Africa is at the moment. So I think Africa has a lot of potential. So we're definitely looking at Africa. We're also looking at setting up a few more funds, possibly in the micro buyout space. We'll probably at some point come up with a second seed fund, now that our first seed fund is finished investing. So we've got a few ideas up our sleeve. I'm sure I'll be back to talk to you about that in detail.
All right, looking forward to that. All right, Anirudh, thank you so much for taking time out and being here with us on Startup Street. And we wish you all the best on this journey going forward.
Thank you. Thank you so much.
Well, we continue the conversation around venture capital funds, and we have Boundless Ventures, which is an early stage venture capital firm that was founded by former K Capital partner Natasha Malpani, and it has announced the launch of a 200 crore rupee fund that is aimed at backing AI startups that are emerging from India. It has already made about 6 investments, including in Pearside, Superhealth, Knot, and others, and the fund will now primarily focus on pre-seed and seed stage investments in companies building AI stacks across consumer, infra, Asian tooling, and vertical applications in healthcare and logistics, alongside made-in-India hardware and deep tech. For more on the company's investment thesis and strategy, joining me now is its founder, Natasha Malpani. Natasha, thanks very much for your time here on CNBC TV18. Boundless is entering a venture market that is already quite saturated with AI-focused funds, whether, even general funds are repositioning themselves as being AI forwards. So what is the distinctive edge that Boundless VC brings, and what is your investment thesis here?
Got it. Thank you so much for having me. I actually think there's not that many funds, especially at early stage, that are entirely specializing on AI right now, right? So that is one of our differentiators, that we are an AI first pre-seed seed fund. And we have some very deep thinking in terms of the different markets we want to back in consumer, vertical AI infra, deep tech. But of course, given that we are early stage, we will be founder first and market second. But we think that, we're literally at day -1 when it comes to capturing the AI wave. So we are looking at this, a very exciting journey of backing some real breakout companies from India, either for India or for the world, over the next decade.
Okay, Natasha, 200 crores is meaningful, but not really massive by global standards. I wanted to ask how you plan to compete with heavyweight AI investors that can write bigger follow-on checks, especially if the founders need, a capital-intensive runway.
Right. So we have been very intentional in the choice of the fund and the check size. We are very clear that we want to do 200 to 400K as the initial check with room to follow on. And the point is that we come in early, right? We are willing to take that sort of underwriting risk and back teams in markets that might not be obvious from the outset. We want to back that sort of category defining company. And I think you can see that in our portfolio, whether it's Pearside, which is real-time ocean intelligence, or Armatrix, automated snake-like robotic arms, or, even Superhealth, rethinking healthcare from an AI perspective. We want to come in early. And then obviously we plan to be very collaborative in partnering with larger funds to help take these companies to the next stage.
Well, let's talk about some of these companies that you mentioned, because the fund has already invested in 6 of them. What patterns or founder traits are emerging that convinced you that they can really build defensible companies in this AI space, which is quite crowded again?
Yes. And as you'll see, right, our first 6 investments already are extremely differentiated. two are in deep tech, a couple are in consumer, one is in AI infra, one is in vertical AI. Basically, what we're looking for, of course, will differ by sector. But we are looking for founders who have that ambition, vision of actually reshaping a market, who are thinking from first principles, who have that both ambition and then that relentlessness to believe that they can shape the world around them. We are also interestingly looking for founders who obviously have a science or technology background, because this is a deeply technical field, and the world of AI is changing so quickly that you have to be updated constantly to keep up with the waves that are happening across the world. But we are also looking for founders who actually bring a storytelling and design edge, which we think is differentiated, because I think in today's market, you need a certain level of velocity and distribution, especially if you're building in consumer AI or vertical AI, to be able to stand out. And actually, even if you're building an AI infra or hard tech, you have to be able to tell that story to be able to, convince your investors to be able to take that very long-term bet on you. So we're looking for that mix of science and storytelling in our funders. And actually, otherwise,
that's a long list you've got there, Natasha. Yeah. That's a long checklist you've got there for founders. Natasha, I wanted to quickly ask, beyond these 6 companies, what's in the pipeline? Have you already identified some startups you want to invest in? And how many in total will you be giving this 200 to 400 crore rupee check size to?
Yeah, so we'll be investing in 20 to 30 companies. Honestly, our pipeline is massive. So I think the question is not pipeline. I think the founders themselves, have recognized that this is the start of a wave. So there's a lot of extremely talented people who are building, right? And here, I think in AI, it's not so much your college degree, it's what can you actually build. In consumer, it's, what insight do you actually have of consumer behavior changing? Whether it's vertical AI or AI infra, it's, what have you actually built in terms of product? You need to move beyond demo to deployment. So we are seeing a very, very exciting pipeline across the board. And even in hardware, deep tech, I have to say, I'm meeting some fascinating founders. Of course, some very experienced founders, in space tech, people who've worked at ISRO for 10 years, but then also, people who are building autonomous cargo airplanes, or people who are trying to rethink DNA as storage, who sometimes themselves are college dropouts. So I think it's very interesting in terms of the archetype of founder also changing in this AI wave, right? Because age is not a bar.
Sure. Natasha, quickly, you sort of laid out the criteria you're looking at from the founders. What about the investors that have given you money for this fund? What sort of returns could you promise them, from the kind of companies you're looking at and the kind of investments you're making?
Yeah, I think, we're an early stage fund. So we will be promising the sort of returns that a pre-seed seed fund would promise at this stage. But obviously, the point is to actually try to be in some of these exponential companies, right, that can return the fund multiple times over.
Yeah. Yeah, well, we'll wait to see what you do there, Natasha. Thanks very much for your time. It's been a pleasure speaking with you.
Thank you. Thank you so much.
On that note, we're going to slip into a short break, but up next, India's gardening market is sprouting fast and Ugaoo has already hit 100 crore rupees in annual recurring revenue. A special report on their growth blueprint and more coming up after this break.
Welcome back. You're still with us on Startup Street. India's gardening market is sprouting fast, and Ugaoo has already hit 100 crore rupees in ARR. With that, the company also announced its newest brand ambassador, actor Jackie Shroff. CNBC TV18's Rachna Dhanrajani caught up with founder Siddhant Bhalinge to understand the growth challenges and what's next for the firm. Take a look.
Balconies are turning into mini forests and desks into leafy retreats. Riding this green wave in India is Ugaoo, a startup that's growing its roots in the urban gardening market with a business that has reached 100 crore rupees in ARR. But as demand blossoms, competition is coming on strong, and there are other problems looming large. Founded in 2015 by Siddhant Bhalinge, Ugaoo blends 3 generations of agricultural heritage with modern horticultural science. Over 1 million orders shipped in 3 years, selling 2.5 lakh plants every month to more than 3 million customers. A 47 crore rupees Series A last year is now funding retail expansion, production capacity and tech upgrades. Unlike aggregators, Ugaoo owns its 25-acre farm near Pune, giving it control over quality and pricing. Patented packaging, educational content and omni-channel reach. From its app to Blinkit and 10 offline experience stores have helped the company achieve a 36% monthly repeat purchase rate. But the $500 million Indian gardening market is now attracting new entrants. From quick commerce plays to local nurseries selling online, the space is getting intense, with logistics prices rising. Along with maintaining an inventory that's live and perishable, Ugaoo will also have to defend its margins while expanding to 80 stores by 2030. So how will Ugaoo do it? How will Ugaoo be able to defend its margins while maintaining plant quality at scale? Thank you so much, Siddhant, for joining us on CNBC TV18. I'd like to first start by asking you, you've hit an ARR of 100 crore rupees. What does profitability look like? How much of it is bottom line? How much of it is top line?
So last year we reached about 100 crores and this year we are going to about 140 crores in ARR. We have been break even last year and this year we plan to achieve at least 3% profitability right now. And bottom line we're looking at around 2 to 3 crores in FY26.
But I also want to understand that managing live inventory can be tricky. So how is it that you differentiate yourself with your competitors, especially now that the scene has so many new entrants? How do you manage inventory while also defending your margins?
So there's a big difference between Ugaoo and its competitors. We are the only ones who actually grow our own plants. We have a 25-acre nursery and we have very rigorous systems and processes set already. So we are able to manage inventory and also manage the entire supply chain to all our regional hubs as well as more than 20 cities in the country right now very effectively.
So what's your wastage rate like?
Our wastage rate is less than 1%. The good thing about plants is that, if you're not able to sell a plant in a 4-inch pot, we have to transfer it to a bigger pot. So the price of the plant appreciates with time. So our inventory value goes up rather than it becoming a wastage for us.
But also, how do you plan out different geographies? Because you are based out of Pune, the inventory is coming from Pune, but you're also supplying everywhere else. So how do you manage the supply chain?
So the idea is that we produce all our plants, almost 3 lakh plants a month in Pune. We have regional hubs in Delhi, Bangalore, Hyderabad, Kolkata, Mumbai, where we send the plants, we acclimatize the plants for about 30 days over there and then sell it to the consumer. So the plant is quite sturdy, is acclimatized to the weather conditions over there and does really well, does not die soon and at least lasts for about 6 months.
Right. So 80 offline stores by 2030, that's the outlook that you've shared with us.
Planning
before.
for 100, but I think
100.
we'll be there at 80.
But at what point does it break even for each store, and does this expansion mean diluted margins on D2C?
So right now the break-even point comes at about 15 to 18 months, depends on the store size as well. Smaller stores are often around 14, 15 months.
Let's speak about this one, where this has to be the most prime location store. We're in Linking Road in Bandra.
Yeah.
What's the break-even point for this? What would be, if you could give the economics of this store?
So right now this is about 800 square feet. This is our smallest store in India. We broke even on this within 12 months. Right now it's at an EBITDA of 20%. And the reason for that again is that we control the, we have backward integration. Most of the products here are produced by us, so our margins are very healthy. And the product quality is way better than what is available around.
Ugaoo's bet is that urban India's love affair with greenery will outlast the pandemic and become a lifestyle staple. But in a market where trends shift quickly and competition is multiplying, whether this growth story stays evergreen or gets cut short will depend on execution, margins, and market discipline. In Mumbai, Rachna Dhanrajani.
Okay, and on that note, it's a wrap on this edition of Startup Street. From Arundhati and me, it's a goodbye and thanks for watching. More news and updates will continue on the other side.